Hello and welcome. This is the Mutual Fund Show on NDTV Profit, and my name is Alex Matthew. This is where we break down concepts and give you actionable insight so that you can make your investment decisions with confidence. On some occasions, we also like to speak to the people managing your money, the fund managers. It gives you an opportunity to understand their thought process and methodology and how they're reading the trends right now. My guest today has managed to beat quite a few of his peers in the two major funds that he manages. One is a mid-cap and the other is a flexi-cap fund. Joining me in studio is Niket Shah, the fund manager at Motilal Oswal AMC. Thank you so much, Niket, for taking the time.
Thanks, Alex, for having me here.
So before we get into each of these funds, and I would like to, of course, break these down and talk about your approach, and I guess there will be similarities, but let's talk about the overarching framework of the fund house and how your own approach to portfolio building fits into that.
So, Alex, as a house, we have always focused on the QGLP philosophy, which is, identifying the right stocks with very high growth without compromising on quality and provided they're available at reasonable valuations. Once you get these three combinations right, we've generally seen that it's a recipe for a multi-bagger, right? Okay. Or significant returns over the index. So that has been our overarching philosophy. The second important thing that we have now added over a period of last 3-4 years, because the markets have got much more broader. If you look at from 2010 to 20, market was extremely polarized with few sectors doing very well. Who thought that sectors like railways and defense will do so very well post-COVID? So the markets have become more broader, and hence what we have now started to do is that we are looking at different themes. We want to ensure that most of the themes that we want to play for the next 3 to 5 year period, we are invested ahead of the curve. And that has really helped us in the last 4-5 years to really perform well as compared to some of our peers.
Okay, so and what is the approach that you take as a manager of a fund within this overarching framework?
So I think for us, what is important is that you identify themes ahead of the cycle. And some of these themes might not be near-term themes. We generally look at investing in businesses with a 3 to 5 year view. Obviously, markets have become extremely faster nowadays. Something that you think that is going to come in next 2 to 3 years from a return standpoint comes in 6 months or 1 year, and you have to act by tweaking it down. But for us, primarily, thesis has always been that we will focus on themes with a 3 to 5 year view. Themes where today the market is not appreciating it, and over a period of time, market will realize that there is significant value in some of them. Just to give you some example, if you look at some of the food delivery businesses that we bought much earlier in the cycle, or recently we've added telecom in a material fashion. These are themes that we believe that will play over the period of next 2 to 3 years in a significant fashion. And we want to be ahead of the curve by positioning ourselves and all our funds.
So that's what you're doing currently, but talk to me. So you said that this is something that you changed about 3 years back. Talk to me about things that you've done over that period, because I would think that in order to have a consistent outperformance, you need to get the strike rate more or less right.
Right.
And not all of those themes will take off when you want them to take off.
Sure.
So talk about both ones that have worked and ones that have not.
So for us, multiple themes have actually worked in the last few years. So post-COVID, we went overweight on IT because it was extremely visible that tech will become the next big thing, given the fact that everyone was working from home. Subsequently, when tech really went through a valuation of 40 times, 45 times 1 year forward earnings, we thought that these are not sustainable. We actually went underweight on tech at a time where tech was a darling of the street. And we looked at capital goods, environmental clearances over a decade were at a lifetime high. We thought this is the time to go overweight on capital goods. If you look at the gross capital formation, was about 36% of GDP in the past, which has come down to 27% and now started to go back to about 30-31%. A lot of the stuff like PLI, Make in India were clearly visible and the benefits were about to come. So we went overweight capital goods, again, much ahead of the cycle, before the cycle really started. The third thing that we also did is, a lot of our themes like EV, right? We looked at companies where in the next 5 to 7 years, if EV penetration in the country has to materially move up, which are the companies which will benefit?
Not just the OEMs?
Not just the OEM, but from an ancillary standpoint as well.
Okay.
So which are the companies which will benefit? Now within EV, whether it's 2-wheeler, 4-wheeler, 3-wheeler, where you really want to put your money on, because where is the profit pool? The profit pool lies in 3-wheeler, and 2-wheeler and 4-wheeler will be a fierce, full-fought battle.
Yeah.
So again, having that granularity breakup of where you really want to go and put your money on. Fourth that we also did is, if you look at over the last 3-4 years, we've moved out of the large cap IT, we've moved into mid cap IT, right? We believe AI is going to be a next big thing, and I think it will surprise all of us at the speed of which it is going to come to us. And I think the amount of benefit that the Indian tech companies will get over the period of next 2-3 years will be absolutely staggering. This is, I think, the next big innovation post-internet.
So you're going overweight now on IT again?
So we actually went overweight last year on IT
Okay.
when some of the large cap companies downgraded their guidances and tech went down. That was the time we went materially overweight on IT as such. And last but not the least is telecom, which I mentioned earlier. We believe this year is going to be a year of telecom. I think if you look at global ARPUs versus Indian ARPU, I think we are at far lower levels. The time is right to materially move up those ARPUs.
For all the entities?
For all the entities, hopefully. And over and above that, I think the penetration in the country for telecom is extremely, it's very well penetrated. So I think the next round of ARPU hike increase should happen sometime post-election. And that should lead to a further round of re-rating for most of the players.
Let's talk about both of the schemes individually. And I want to start with the mid-cap scheme. Assets under management of close to 9,000 crore. And we can pull up some of those numbers on the screen. The fund's one-year performance is about 61.4%. Benchmark is 64.95%, which is interesting. But the category average is much lower at 50.9%. It's something of opposite ends, right? Or rather, flipping the story, where you're talking about large cap, which has failed to beat the benchmark for a long period. But then that role reversal took place over the last year, where you said mid-cap and small-cap fund managers have found it much harder.
Yeah.
Why is that?
So I think one reason is that the market has become extremely broader.
Right.
I mean, fund managers who have managed money for a long period of time have been used to buying certain set of stocks, right? Sectors like defense, sectors like rail, PSUs. No one thought they would have got to such an extent. So it took everyone by surprise. Now, for us, thankfully, we actually had, while we didn't have allocation to a lot of the PSU names, we had allocation to some of the other names which did very well for us, equivalent to what PSU would have done.
But Niket, I'm looking at your portfolio, and in both the mid-cap and the small and the flexi-cap, and I'm asking you this because it is relevant for both, the number of stocks that you're holding in the mid-cap is 22. If I'm not mistaken, there are 27 in the flexi-cap fund. And the top 10 holdings, it's what, 67% for the mid-cap fund, 65+% for the flexi-cap fund. This is a very small number. Doesn't that make your job harder?
Yeah, so Alex, we don't start at such higher weights. We generally start at 6 to 7%.
Sure.
It's just that those stocks have become 4x, 7x, 8x over a period of time. I think it's a good problem to have if you buy something at 6, 7%. I think the team has a very high conviction on a lot of stocks that we actually allocate. So wherever we have a large theme, the team has high conviction on it, we will go and allocate reasonable amount of capital on it. And over a period of time, when they multiply materially, say 3 times, 4 times, the weights tend to move up. And we do manage risk by cutting down weights if it moves about 12% or 13%.
So you're talking about weights of individual stocks. There are a couple of those in your portfolio right
That's
now.
correct.
So what you're saying is that, but 10%, isn't it mandated to have 10%?
No, so the regulation says that you can't buy more than 10% active on day one.
Okay.
Right, you can buy 9.99.
Right.
And then if the stock price appreciates,
right,
and then it goes to 12, 13%, that's allowed. But then that's an internal philosophy that we have that about 12, we won't allow it to go. So we will cut it off.
So and on an ongoing basis, you're saying that this is par for the course. If you see a concentration of 65% in the top 10 is nothing to be, nothing unusual from your perspective.
No, I think it is slightly unusual because what has actually happened is the stock bets that we took last year, thankfully all of them did very well. And all of them are either up 3 times or 4 times. And that's the reason why we have that kind of performance. Now, over a period of time, as the size really moves up, we will have to move to more number of stocks.
Yeah.
Having said that, when we buy some of these names, right, where we have 7-8% allocation to start with, I think the fundamental philosophy that we follow is that the downside risk has to be much lower.
Yes.
Right. So the risk-reward ratio has to be much more in your favor. Otherwise, you can end up, having a material bad year if there is a significant drawdown in markets.
So, but wouldn't your downside be protected if you have less of a concentration in a few stocks? So I'm trying to understand what the philosophy is.
So the philosophy is that if you have high conviction ideas, you bet big on them. And if you have done enough amount of work and enough amount of research on them, why not play it, with reasonable amount of weights?
Right.
Now, reasonable can be 5, 4, 3, 6, anyone's guess. For us, if there is extremely high conviction that we have, we believe that this is a company where the market is mispricing it materially, and it should effectively over a next 3 to 5 year period give us disproportionate return on our investment. We will actually start with 5 or 6%. Now, if that stock multiplies it's a good problem to have.
Okay. So the other aspect that I'd like to talk about is, of course, the sector allocation. And there are similarities in both the funds, obviously, because you're
Right.
looking at the same set of stocks, right? There is and I'm looking at the mid-cap fund right now, there is the largest allocation towards technology. And there is also a significant allocation in both flexi-cap as well as mid-cap towards consumer cyclicals. Talk about some of these bets.
So I think tech, as I said, we believe that the mid-cap tech will do extremely better than the large-cap ones. I think some of the mid-cap names don't have a headwind of AI, right? Some of the large-cap ones do have some headwind of AI. If AI becomes larger, some of their business segments might start to decline as such. Having said that, the base of the large caps are much higher as compared to mid-cap companies. So obviously the percentage growth will look much more better for the mid-cap names as such. So we want to play that entire AI theme over the next 2 to 3 year period. And within that AI theme, which are the companies which are rightly positioned, is something that we want to really bet on. Within tech also, if you look at a couple of names that we have, is something on EV side, right? They do large amount of tech work or ER&D work for auto business as such. Now, if you look at the whole EV value chain, right? It starts with tech first.
Right.
You get the tech right, you get the, the entire, ecosystem right, and then the car comes and then it goes to the market, right?
Right.
So we want to play the first cycle first, and then we will play the other cycle. We have bets in the other cycle as well. But we started with tech first because that's the first starting point for any EV manufacturer, any EV OEM to start with.
Okay, so we've got a fair sense of how you manage the building of your portfolio. I'm curious about what you think about valuations as they stand right now, broadly, in these funds that you operate, because you're looking at the broad spectrum and you're looking at mid-cap very closely. So where does it stand right now? Are you comfortable based on the kind of earnings growth that you've seen? IT, of course, we're bang in the middle of the earnings season. We're waiting for Infosys today. Let's see how that pans out. But and anyway, you're talking about mid-cap IT more than large cap. So how do you see the earnings picture right now, and how do you see the valuation?
So I think, Alex, if you look at from 1997 to 2020, earnings growth for mid-cap index was about 12%. If you look at earnings growth from 21 to 24, it's north of the 40%. So I think one really has to look at valuation in that context.
Okay.
While valuation of mid-cap, if you take a 10-year average, is about 23.5 times. And it's right now at about close to 25 times. So obviously, we are higher than a 10-year average. But if you compare that with growth, we are materially higher than 20-year average.
So it's justified.
Right, so it's completely justified. So whenever there is higher growth, you will see valuation moving up. For example, if this growth had to slow down, the valuation will also come off, right, to that extent. So I think we have to look in that context. Having said that, while the valuation, the headline number looks higher, there are pockets where the valuation are extremely cheaper.
Okay.
Right, where we believe there is value. So I think there are a lot of pockets within the mid-cap space where there is value, and there is still, we believe there is, materially lower valuation as compared to the longer-term averages or global averages, right? And we would love to, have a large part of that as well.
Now, the other aspect, and why I'm curious to speak to fund managers like yourself, is also there is a little bit of noise that was created about a large amount of inflows into the mid-cap and the small-cap space. And there is this new exercise that is being conducted.
Yes.
I would think that to a certain extent you were already, as an industry and as fund houses, doing this and looking at risks emanating from your portfolio. Do you think it serves the purpose to share this information with individual investors as well? And how would you explain the importance of the risk or the stress test that we're currently reading?
So I think, first of all, I think anything that the regulator does, we have to have a much more longer term view towards it.
Sure.
And I think whatever steps regulator has taken in the past on the industry side, most of them, in my opinion, have been in beneficiary to the industry as such, right? And beneficiary to the retail investor specifically. If you look at the stress test in particular, larger the size of the fund, the number of days will be more, right? By design, right? Because there's X amount of finite volume a stock will actually do on a daily basis, right? And lower the size of the fund, that dynamics also plays out. So one really needs to keep that in mind. The second thing is, from a stress test point of view, I think what is important is that in case of a Six Sigma event, how much time would it take for the funds to give you back the money back is what I think a number it is. So I think it's not very, very relevant, for the retail investors to really look at it, whether it's a very well liquid fund, or whether it's a fund where there is a lot of illiquid stocks around it. I think as a fund house, we also do a lot of focus prior to this exercise that we don't need to, buy a lot of, illiquid stocks. And hence, if you look at most of our top holdings, are the ones which are very, very liquid.
Sure.
Right. So I think it would not, one should not get too much perturbed about the numbers as such. But I think it's a much more qualitative feel that the regulator wants to ensure that in a drawdown kind of an environment, the mutual funds are able to honor it.
So the final aspect, which is the opportunity that you have to speak directly to your investors, in this context, and we've spoken about valuations, and you've pointed out that there are pockets where there is actually attractive valuations,
right,
as opposed to people saying that it's across the board expensive. What message would you give to your investor right now?
So I think my message to investors has always been that think for the longer term. And one thing that we always keep telling all our investors is never give up on India, right? I think that every time when you think that the valuation is expensive, or every time you think that there is going to be a correction because market went up too fast, don't try to time the market, right? We have done that in the past and we have failed miserably ourselves. So the lesson that we have learned from our mistakes has been never try to time the market, always be for the longer term. There is an opportunity in market every day, right? Every day when the market opens, there's an opportunity for you to buy a stock and make material returns over a period of 3 to 5 year period. So I think about the longer term, don't give up on India. And yeah, that's a word.
So, and then the other aspect, and this is the final aspect, of course, is that I would think that, so I'm trying to understand. So you've described your portfolio building strategy. Is it all fundamentals, or there are some aspects of quant indicators, vagera, that you look at when you're building?
100% fundamentals. I wish I would know anything about technicals and quantitative quant strategies. Unfortunately, I don't know any of them. So we would like 100% fundamentals. Right. Our energy is 100% dedicated to that.
All right. So Niket, thanks so much for joining in. And in fact, I look forward to more interaction like this over the course of the year to figure out how things are panning out. And always a pleasure having you on the show.
Thank you so much for having me, Alex.